A 15-year mortgage sounds like the smartest move a homebuyer can make. Lower interest, faster payoff, no mortgage in half the time. It feels responsible. But here is the part most buyers never calculate. The mortgage that saves you interest can also trap your cash flow, limit your options, and quietly stop you from building more wealth. Let me show you why. Imagine two buyers. Jake and Marcus. Both buy the same $400,000 house. Same neighborhood. Same income. Same goal. They both want to make the smart financial decision. Jake chooses the 15-year mortgage. His payment is higher, but he feels proud. Every month, more of his money goes toward the house. He tells himself, I'm doing the responsible thing. I'll own my home faster. And honestly, that sounds smart. Marcus chooses the 30-year mortgage. His payment is lower. He has more breathing room every month. Maybe the difference is $500, $600, or even $700. Marcus tells himself, I'll invest the difference. And this is where the real trap begins. Because most people say they will invest the difference, but very few actually do. That extra money slowly disappears into normal life. A car repair. A higher grocery bill. A family trip. A new phone. A dinner out. None of it feels reckless. But after a few years, Marcus still has the bigger mortgage, and he does not have the investment account he promised himself. So at first, Jake looks like the winner. He paid less interest. He built equity faster. He is closer to owning his home. But here is the question most people never ask. Is the goal to pay less interest? Or is the goal to build more financial freedom? Because a paid-off house is valuable. But your house is not cash. If you lose your job, face a medical bill, or need money quickly, that home equity is locked inside your walls. You cannot swipe your kitchen. You cannot sell one bedroom. You cannot easily turn home equity into emergency cash without borrowing again. And that is the hidden cost of the 15-year mortgage. It can force too much of your money into one place. Your house. Now. This does not mean the 30-year mortgage is automatically better. That is where many people get it wrong. A 30-year mortgage only wins if you actually use the lower payment wisely. If you save $600 a month by choosing the 30-year mortgage, and you spend that $600 every month, you did not build wealth. You just bought more lifestyle. But if you automatically invest that $600 every month, everything changes. Over 15 years, that money could grow into a serious investment account. Over 30 years, it could become life-changing. And the biggest difference is not intelligence. It is not income. It is not luck. It is systems. This is the psychology most buyers miss. People do not usually fail because they are bad with money. They fail because they trust willpower. They say, I'll invest whatever is left, but money left in your checking account usually finds a reason to leave. The smarter move is automation. If the 30-year mortgage saves you $600 a month, do not wait until the end of the month. Set up an automatic transfer for that $600 into an investment account right after your mortgage payment clears. Make it automatic. Make it boring. Make it non-negotiable. Treat it like a second mortgage payment. But this one pays your future self. That is the difference between Marcus and someone who actually wins. Marcus had the right idea, but he had no system. The winner is the person who combines flexibility with discipline. And this is why the 15-year mortgage can become a trap. Not because it is bad. For some people, it is actually the right choice. If you hate debt, struggle to invest, or know you will spend the difference, then the 15-year mortgage may protect you from yourself. But do not choose it only because it looks responsible. Because looking disciplined and building wealth are not always the same thing. Jake may own his house faster. But he may also spend 15 years with tighter cash flow, fewer options, and less money working in the market. Marcus may have more flexibility. But if he wastes the difference, he loses too. The real winner is the buyer who uses the 30-year mortgage for flexibility, then automates the difference before life can spend it. That is the hidden strategy. Not more willpower. A better system. So before you choose a 15-year mortgage, ask yourself one honest question. Am I choosing this because it is truly the best financial strategy, or because I do not trust myself to follow a better one? Because the smartest mortgage is not always the shortest one. It is the one that protects your cash flow, matches your real behavior, and helps you build wealth without trapping your entire financial life inside your home. The real mortgage trap is not choosing the wrong loan. It is choosing the loan that looks responsible, but quietly removes your options. If this helped you see mortgages differently, like the video, subscribe, and comment mortgage trap so I know you caught the hidden lesson.